The Waldorf Astoria sold for $1.95 billion in 2014. The buyer is in a Chinese prison. The building cannot open. The money is still in the walls. Anbang Insurance Group acquired the Waldorf Astoria New York from Hilton Worldwide in October 2014 for $1.95 billion, the highest price ever paid for a hotel at that point in recorded real estate history. The transaction was celebrated in both the American and Chinese financial press as a symbol of the new confidence of Chinese institutional capital in the global trophy asset market. The building at 301 Park Avenue had operated continuously since 1931, 83 years, as one of the most recognizable addresses in American hospitality history. Heads of state had slept there. Treaties had been negotiated in its suites. The name carried a weight that no balance sheet had ever been able to fully price. Anbang priced it at $1.95 billion. That figure implied a stabilized net operating income that the Waldorf had never produced and a renovation timeline that assumed a functioning capital markets environment in both the United States and China. Neither assumption has proven durable. The Waldorf Astoria New York has been closed for renovation since 2017. It is now 2026. No credible reopening date has been publicly confirmed by any party with operational authority over the asset. To understand what happened to the Waldorf Astoria, you have to understand what Anbang Insurance Group actually was, because the forensic analysis of the building's current condition cannot be separated from the forensic analysis of the institution that acquired it. Anbang was not a conventional insurance company deploying premium reserves into real estate. It was a capital aggregation vehicle that had grown from a small automotive insurer into a $300 billion conglomerate in less than a decade, through a combination of high-yield insurance products that function more like wealth management vehicles than conventional policies, aggressive acquisition of trophy assets across multiple continents, and a corporate governance structure that concentrated decision-making authority in a single individual whose relationship to the capital he was deploying was never adequately examined by any regulator until it was too late. The debt-to-equity ratio embedded in Anbang's balance sheet at the time of the Waldorf acquisition was a structural liability that the Chinese regulatory environment had not yet identified as a systemic risk. By 2017 it had. The building stopped. The investigation started. The marble has been waiting ever since. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The covenant nobody read. Wu Zhaohui founded Anbang Insurance Group in 2004 with capital that Chinese regulatory investigators would later describe in court documents as having origins that were difficult to trace with precision. By 2014, the year of the Waldorf acquisition, Anbang had accumulated assets under management that placed it among the largest insurance groups in China by reported balance sheet size. The operative word is reported. The forensic audit conducted by the China Insurance Regulatory Commission beginning in 2017 found material discrepancies between Anbang's reported asset values and the actual composition of its investment portfolio. Discrepancies of a magnitude that suggested the company's growth had been financed not through legitimate premium accumulation, but through a structure that Chinese prosecutors would eventually characterize as fraudulent fundraising. The covenant that no regulator read carefully enough was not written into any specific loan document. It was written into the structure of Anbang's insurance products. The company had sold high-yield investment-linked insurance policies to retail investors across China, promising returns that required the underlying assets to generate income at rates the assets were not producing. The Waldorf Astoria, closed for renovation and generating zero-room revenue, was one of those underlying assets. A building under construction cannot produce the yield that retail policyholders in Shanghai and Shenzhen had been promised when they purchased the products that financed the acquisition. The capital structure underneath the Waldorf renovation was therefore dependent on a continuous flow of new premium income from Chinese retail investors to service the obligations to existing policyholders, a structure that Chinese regulators identified as Ponzi adjacent in their 2018 court filings. When the regulatory intervention froze Anbang's ability to raise new capital in the domestic Chinese market, the renovation financing became structurally compromised. The construction draws that had been expected to come from Anbang's operating cash flows stopped arriving with the regularity the renovation schedule required. Wu Zhaohui was detained by Chinese authorities in June 2017. He was convicted of fraud and embezzlement in May 2018 and sentenced to 18 years in prison. The Chinese government took over Anbang through a state-administered restructuring that transferred control of the company's assets, including the Waldorf Astoria, to a state-backed entity. The building that had been acquired as a symbol of Chinese private capital's ambition in the American market became, through the mechanics of its own financing structure, an asset of the Chinese state. At what point does a regulator's failure to examine the source of capital behind a trophy asset acquisition become a systemic risk to the asset itself? Leave your analysis in the comments below. The appraisal that didn't hold. The $1.95 billion acquisition price implied a stabilized value that rested on three assumptions, each of which has been invalidated by subsequent events. The first assumption was that a comprehensive renovation of the Waldorf's 1,413 rooms and approximately 100,000 square feet of event space could be completed within a timeframe consistent with the financing structure that Anbang had assembled. The second assumption was that the post-renovation Waldorf would generate revenue per available room sufficient to justify the acquisition price at a capitalization rate consistent with the 2014 trophy asset market. The third assumption was that Anbang itself would remain a functioning institution capable of deploying the capital required to complete the renovation. All three assumptions failed, in sequence, beginning with the third. The renovation timeline that Anbang had initially projected called for a phased reopening beginning as early as 2020. That timeline assumed uninterrupted access to renovation capital, a stable regulatory environment in China, and a New York luxury hospitality market operating at or above its 2014 trajectory. The 2017 regulatory intervention in China eliminated the first condition. The 2020 global pandemic eliminated the third. The second has never been tested because the renovation has not been completed. The appraisal methodology that produced the $1.95 billion valuation treated the Waldorf's brand equity as a revenue-generating asset, without adequately pricing the capital expenditure required to restore the physical asset to a condition consistent with that brand equity. The building had been operated continuously for 83 years at the time of acquisition. The deferred maintenance and the obsolescence embedded in an 83-year-old hotel acquired a renovation investment that independent construction analysts estimated at between $1 billion and $1.5 billion before any revenue-generating operation could resume. That capital expenditure obligation was known at the time of acquisition. It was not priced into the $1.95 billion figure in a way that produced a post-renovation stabilized value supportable by the asset's projected operating cash flows. The forensic audit of the acquisition therefore reveals an over-leveraged acquisition that was structurally compromised before the first wall was open. The appraisal said $1.95 billion. The renovation budget said something the appraisal had not fully absorbed. The regulatory intervention said something neither document had anticipated. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The architecture of denial. The geopolitical dimension of the Waldorf Astoria's paralysis is documented in a regulatory record that the appraisal methodology of 2014 could not have priced because the regulatory environment of 2014 had not yet produced it. The Committee on Foreign Investment in the United States, the interagency body known as CFIUS that reviews acquisitions of American assets by foreign entities for national security implications, had reviewed and cleared the Anbang acquisition of the Waldorf in 2014. The clearance was granted under the Obama administration. It was subsequently reconsidered under the Trump administration in the context of a broader reassessment of Chinese institutional investment in American trophy assets. The Waldorf Astoria's specific national security profile is not incidental to its architectural and financial history. The hotel had served as the official New York residence of American ambassadors to the United Nations since 1947. A significant portion of the building, a dedicated residential suite on the 42nd floor known as Suite 42A, had been maintained for that purpose. The acquisition of the building by a Chinese conglomerate whose ownership structure and capital sources were later found to be fraudulent raised questions about the security of communications and activities conducted within the building that CFIUS had not fully resolved at the time of the initial clearance. The practical consequence of the national security dimension was a restriction on the sale of the Waldorf to certain categories of buyers that complicated the asset management decisions of the Chinese state entity that had inherited the building through the Anbang restructuring. A building that the Chinese government controlled but could not easily sell, could not reopen without completing a renovation, lacked the institutional continuity to manage, and that carried geopolitical symbolism incompatible with the straightforward commercial resolution, was not a real estate asset in any conventional sense. It was an architectural liability denominated in American dollars and Chinese political complexity simultaneously. The renovation has continued at a pace that independent construction observers have described as inconsistent with any commercially motivated reopening timeline. The building has been under scaffolding and active construction for 9 years. The hotel rooms that are being converted into private residential condominiums have been marketed at prices that imply a post-renovation stabilized value consistent with the original $1.95 billion acquisition price. The market for those condominiums has not yet validated that implication. What the marble outlasted. The Waldorf Astoria New York remains, as of the time this episode was produced, in an intermediate state that has no precise precedent in American hospitality history. It is neither a functioning hotel nor a completed residential conversion nor a distressed asset available for acquisition at a market clearing price. It is an asset whose ownership, financing, regulatory status, and operational future are each subject to constraints that originate in jurisdictions and institutions that have no direct commercial relationship with one another, and no shared incentive to resolve the building's condition on any particular timeline. The Chinese state entity that controls the asset, Anbang Insurance Group, the successor vehicle to the restructured Anbang, has continued the renovation and has marketed the residential condominium units that are being created from the converted hotel rooms. Sales have been reported at prices consistent with the premium end of the Manhattan luxury residential market. The hotel component of the building, which Hilton continues to manage under a long-term agreement that survived the ownership transition, has no confirmed reopening date. The suite that American ambassadors to the United Nations once occupied has not been rededicated to that purpose. What the Waldorf case reveals about the current trophy asset market is a dimension that the Plaza and Fontainebleau cases do not contain. The risk that the capital structure financing and acquisition is not merely over-leveraged but illegitimate, and that the illegitimacy of the capital is not detectable through any conventional due diligence process available to American regulators or counterparties at the time of the transaction. The appraisal methodology failed here not because it used optimistic inputs, but because the inputs it used assumed a counterparty whose financial statements did not accurately represent its actual condition. The building will reopen. The name is too valuable and the residential conversion too far advanced for any commercially rational steward to abandon the project. But the reopening will occur under conditions that no party to the 2014 transaction anticipated, at a cost that no appraisal produced in 2014 projected, and after a closure that has lasted longer than any renovation in the history of American grand hotels. The marble has been waiting. It will continue to wait until the capital structure and the geopolitical environment that trapped it find a resolution that neither has yet produced. If this case file changed how you evaluate the source of capital behind trophy asset acquisitions, subscribe to this channel because the next case examines a building where the collapse was not financial, but physical, and the engineers who signed off on the structure knew something the investors did not. And in the comments, given the CFIUS clearance that was granted in 2014, and reconsidered afterward, what specific disclosure requirement would have changed the regulatory outcome of the Waldorf acquisition? The case file is open.